Thank you everyone who's joined here. I think me and Rajiv are, excited. You'll have to apologize. Sorry, you'll have to help me, a bit here. I'm not feeling a little well, but I'm happy to, actually have this conversation with you folks, right? So, let's, I will be more than happy in case you guys want to switch on your cameras, not acting as, somebody who is forcing it out, but it's awesome to see people, interacting with each other, right? More or less, this it's so we've prepared a very basic conversational presentation, right? But so as we start, right, as we start to understand term life insurance, there are a few questions that we really wish to ask, right? Also, firstly, is my screen visible, Aisha and Rajiv?
Yes.
Yes.
Great. All right. So, Aisha, can we start with those questions that we had? Guys, okay. Why don't you guys answer the first question, right? Like, what is the age group that you guys are from? Interesting to see a lot of folks, young folks in this session. Okay, we see the tilt moving. I think there are a couple of more who are yet to answer. We've got 77 people. Let's try and get each one of you at least, this answered. That gives us a fundamental idea of how we can structure this conversation and how we can talk about specific points related to each age group. Another couple of more seconds, and then I think we'll move to the second question. Sorry. Okay. All right. Let's move to the second question, Aisha. I think we've got a great participation here, right? We'll also share the results later, but this is an interesting question, right? Why don't you guys answer this, right? I'm pretty sure that while we all know the answer, but it'll be really interesting to see. Wow. Almost 75% of you essentially have a policy from LIC. I'm pretty sure you guys are proud shareholders of LIC as well. Okay, we'll have 10 more seconds, and then probably, Aisha, we can share the results as well, if possible. Okay, great. I think almost 90% almost folks participated, and 75% of you essentially have a LIC policy. That's something very interesting to hear, right? So now coming back as to what is it that we're going to cover in this presentation, right? Or let's keep it more interactive. I'll be more than happy to take up. Okay, Muskan says that I think she has LIC policy but lost so much of money during the IPO. I completely empathize, Muskan. I also lost the same. My parents also lost the same amount of money there as well, right? Now coming back, right? What are we essentially covering in this presentation? Firstly, is the rudimentary understanding of term insurance, right? Secondly, the most common questions that you're going to get, right? How do you decide the cover amount? Which company should I buy from, right? What is this add-on riders that these companies keep on pitching us, right? At what time and age should I buy, right? What is it? Okay, the other questions that we really want to answer is like the LIC. 75% of you have a LIC plan, right? And also around 70% plus folks in this session are below 30 years, right? So we also want to discuss essentially the understanding of what these plans are of LIC and how do they compare against a term insurance, right? Lastly, before we step out, we also wanted to, talk about what is the Nova advantage, right? And what is it that you specially get from Nova, about this term insurance and its consultation, right? I think me and Rajiv will like to have this as a more conversational, we'll keep this talk as more conversational. You guys can keep dropping in questions. You can just unmute yourself, ask questions. We'll be more than happy to take them up as and how it is, right? So now I think coming to the what is term insurance, right? In simple words, a term insurance allows you to essentially get, or let's say your family get, benefit, right, at the most uncertain times, which by the usage of a negative word is death, right? At the time of death, untimely death, essentially your family or your nominees get a certain fixed amount that you have chosen, right? Also, for let's say the brevity of this conversation, and we are all, we really want this conversation to be really positive. We'll avoid the usage of word death. We'll keep it as unfortunate circumstances, right? um, I mean, I'm a joyful person, and I really want to ensure that all of you are joyous as well, right? So yeah, what is term insurance, especially as I spoke about, right? It's essentially the basic, coverage of yourself, right, to protect you against, untimely demise or somebody in your family or for yourself, and giving your family or dependents, right, uh, enough coverage amount so that they can live a life which they are, right, which you are having about, right? So excuse me for that, right? So Rajiv, let's why don't you unmute yourself, why don't you keep adding yourself, why don't you keep adding here as well, right? What do you think, essentially what is the simplest definition according to you is of term insurance that you have explained to someone?
Right. So for me, term insurance is a financial, like, I mean, obviously you can't put a cost of life to a person's
Correct.
life, right?
Right.
But what
Yeah.
I feel a term insurance is a financial replacement for a person in
Hmm.
case of an unfortunate, an eventuality happening ever,
Right.
right? So the
Right.
family continues to live the same standard of living. But yeah,
Correct.
obviously you can't replace a person, but you can replace them financially. So that's close to as good as it can get, right? So that's what a term insurance is.
Yes, yes. That's you very well said. While you cannot replace a person, when somebody, or let's say once some family, or let's say somebody close leaves, right? I
Right.
think financially we ought to do. We take up. I think on a daily basis we see a lot of people come and talk to us about what term insurance in case once they're not there.
Right.
um, is there something specific, or what do you think is the weirdest point somebody has asked you about term insurance, right? About what is term insurance, what is the weirdest question somebody has ever asked you about?
So I mean, the weirdest part is people think of term insurance as an investment, right?
Got it.
Which it is not, right? Clearly, I mean, people look at term insurance as to grow their investment pool or have a big enough corpus sometime in the future, right? And that's why they come seeking for an insurance, term insurance, right? Which is
Got it.
totally misaligned with what that product actually does. So
Great. Yeah, yeah. So we'll talk about this, about the difference of how, what is the nature of term insurance and why it should be kept absolutely separate from investments when we talk about, the ULIPs, money back, LIC guaranteed plans
right,
versus the term insurance part, right?
right,
So now let's jump to the next question, right? I think a lot of people essentially ask this question that they have been told or essentially misaligned with what is the right cover amount I should get? How should I decide it? Right?
right,
Um, I'm so young. I think I don't have consultations with most of the folks on a daily basis, right? So how do we decide the cover amount? Is there a specific answer to that question? Is there a right way that you can decide it, right? what do the insurers look for when, when they tell you that please choose X amount of insurance cover? So how has your take been on that?
Right. So, I mean, cover amount is, I mean, it's not one size fits all
Yeah.
kind of a solution to this. But what we figured is that instead of how traditionally it's done, we've had a very different approach. Traditionally it's basically people telling you, the insurers telling you that go for a cover amount that's 20 times the CTC or 25 times the
Right.
CTC, right?
Right.
But which is not prudent. In what we figured out is, a person must take into account of all of their current investments, their liabilities, their loans, and
Okay.
then calculate a cover amount based on their current standard of living, right? So how
Okay.
we've done that is by basically taking a monthly expense sum of the family in that person's absence, right? Let's
Right.
say 30,000-40,000 rupees
Right.
per month, and then we basically take inflation into account and the rate of return in case
Okay.
the family gets the term amount money, right? And then decide the cover amount which would be suitable for them, right? Based on the net present value of money, which is
Got it.
taking inflation into account over a large, like a large period of time, a very long
Got
period
it.
of time.
So let's break it down, right?
Yep.
As you mentioned, that first thing to understand is what is the amount family will need per month, right? I think
Right.
that's one of the critical understandings that people have, right? What do you
Correct.
think are the components of this, right? What all should one include in this?
Right. So this would include their family's daily expenses. If they're thinking of major expenses such as an education of a child's education, or basically I mean everything that's related to day-to-day life, transportation, and housing, rent, and everything else, right? So these are just then an amount that would cover the basics basically in
Okay.
a month, in a given month. Is a monthly expense.
Got it. Got it. Also, Rajiv, what is your take on, usage of, let's say, you know, like there are also people who plan a lot of milestones, right?
Correct.
For example, birth of somebody, right?
Right.
Marriage, right?
Right.
Are these factors also taken into
Yes.
consideration?
Yes.
Okay.
It
Okay.
will be
And how?
extremely important to take such things into consideration, because with term insurance, it's a contract which gets locked in at the time of purchase, right? So all terms get locked in when you're purchasing the plan. So the
Got
later
it.
you purchase, the more expensive, and you lose out on the better terms that you could get, basically.
Okay.
Right.
Okay. Okay. Got it. Got it. All right. So I think so coming now, just giving the benefit to the audience to understand the right coverage amount. I think the answer here, folks, is firstly, please, the way we are going to do it is first we calculate what is the right amount of monthly expenses that you think your family will need in your absence, right? That's point number one. How do we calculate that? You take into consideration the daily living expenses plus also the future expenses that you might have in consideration, such as if there is a marriage that is going to happen, if there is if there is a birth of, or if you're planning for children, right? All these things need to be factored in before you decide for a monthly expense, right? Once that monthly expense is essentially taken into consideration, uh, the right way to see it is the next step that we mostly ask people to understand is to take into consideration inflation, right? Today inflation might be at 7 to 8%, right? Inflation in simple terms is essentially that today if a good is costing rupees 10, right, tomorrow it's going to cost you rupees 11 or 12 depending on what the inflation is, right? uh, Typically India's inflation is about 4%, right? Which is why the methodological way that we do is take your expenses, use inflation to calculate what is called as the net present value of your money, which means that let's say till what age you will be getting your coverage for, right? Till that age, what is the inflationary amount, or what is the inflation percentage needs to be taken, right, to get the right sum, right? Rajiv, do we have a calculator that we can essentially show people right now?
Yes. I'll just share my screen.
So we will is there a volunteer that we can essentially have maybe I think let's, I think, can we have a volunteer, somebody, who can essentially just help us? Maybe for somebody, we can do a live consultation and show them, what would be the right amount of money they would need for.
Hi, I would like to be volunteer. Anukul this side.
I'm sorry. I'm sorry. Who was that?
Anukul this side.
Great. Anukul, if you could just give a background about yourself, your age, where you from, how about your family a little bit, if you're married or not.
Yeah. So Anukul, age 28, and I'm married.
Great.
Right now.
All right. Do you have, do you have children or anything of sorts?
No, not yet.
Not yet. Great. Okay. All right. So let's do this. Anukul, why don't you help us with, what is the monthly expense that you think your family will need, right? In your absence.
I guess something 65,000 or 70,000.
Okay. And how do you think you've arrived at this number of 65, 70, if you don't mind me peeking a bit?
Yeah, sure. So right now I'm staying in Bangalore, and my monthly expenses is around 50,000, 55 sometime. And we are trying to stay in that range, 50 to 55,000. But I believe there are some, to absorb some shocks, I'm taking it to 70.
Okay. And are your parents financially dependent on you? Do you send some money home or anything of that sort?
No. They do get that pension.
They do get their pensions. All right. Got it. Also, Anukul, let's work as I mentioned, right? Are you planning any, events in the near future? Are you planning, let's say, because we are talking about a coverage of, let's say, another, around 38 or more years, right? 37 years more, right? Are you planning for kids or something in the near future by any chance?
Yes. So planning for kids, for their education. So these just a normal plan.
Got it. So, so the point that we're trying to make is, why don't you also think about those expenses, right, to add up into this calculation? Because right now you told that, 50, 55 is half, and 70 is the threshold you're taking, right? Do you feel that those expenses will increase, or you will want to maintain everything under 50K itself?
No. That will certainly increase, and and as I initially told, that 70,000 as of now.
Okay. So, do you wish to increase the amount for your monthly expenses in because you're planning for kids, or do you feel that it is currently enough for you?
No, I guess after having a kid, it will certainly go to a lakh or something.
Got it. So let's do one thing. So we'll take it in two ways, right, Anukul? Once we'll do is your annual expense, what is there as of today, right? And what if, after your children that you have, right? What we'll also show people is the fact that, the cost of term insurance that goes up significantly when you purchase it at a later age, right? So today, Anukul, you're 28, you have expenses of 70,000 a month, right? That rounds up to about 8,40,000, right? Here with me till now.
Yeah, ma'am.
Great. Now, what you see right below is that we've created this calculation, right? That we have said that your coverage should be till the age of 65, right? Now, a lot of people essentially say that,
Ishtmeet, there's one more thing. I wonder if you can make it to the age of 70, please.
Got it. Okay. So I was just trying to help you understand that itself, Anukul. 65 is usually why we recommend 65 is the fact that by 65, if you are, see, the point is you're going to be protecting your dependents, your liabilities, and most of the times, 95% of the times, working people finish or cover their liabilities by the age of 65, right? What I meant by that is by 65, you would have, your let's say assume your children would be sufficient or grown up enough, right? Secondly, in case you have any loans, in case you have any, in case you have any other liabilities, right? They also will be taken care of, right? And thirdly,
I actually I got your point, Ismeet. So if you are explaining it to audience, you can please go. You can go ahead to explain
sure.
it to audience. And for me, the reason to put this number 70 up there, I just wish to. I like to see the number for
Sure.
the 70. If you can go ahead and explain it to audience.
Yeah. Okay. Not an issue. To all the people, out there, we're just trying to help you understand that by the age of 65, usually your liabilities and your expenses or dependents are usually taken care of, right? Beyond that, buying a term product or continuing a term product is more or less a selfish interest, right? It is just a simple understanding that, in case I'm taking it beyond 65, my dependents essentially will get a lump sum amount in my absence, right? Now, if I have to give you an example, if you're taking your cover till, let's say 65, 75 for that matter, right? The next 10 years, you would be paying a certain amount of premium, right? That certain amount of premium, if invested in a, even let's say an index fund, would yield you a decent return, right? So the point that we're trying to make here is the fact that the coverage till you're going to take your age for, right, has to be chosen really wisely, given the fact that you have to consider till what age you think your liabilities will be taken care of, right? Now coming to the next point, right? Uh, Rajiv, if you just go, yeah, got it. So as you see here, right, at the age of 28, Anukul's expenses are going to be 8,40,000, right, per annum, right? Next year, his essentially expenses are going to be 8,73,600, right? How do you say that, why this amount is me, right? Considering that there is inflation, right, you would see that his essentially cover increases every year because Anukul's family would also have to beat inflation in case of his absence, right? Because your goods are not going to get cheaper by the day, but always going to get expensive by the day, right? So which is why we've taken this, right? Now, essentially, as you see on the right hand side, you will see that the calculator essentially says that, this is the cover that he or she will be requiring at this particular point of time in case there is untimely demise, right? 2 crore 89 lakhs 12,998 is simply because if essentially if you require 8 lakh 73,600 for the rest of the years, which is still age of 70 of Anukul, right? You would require at least 2.89 crores, right? That yield that that come up to 8,73,600 per year, right? Which would allow Anukul's family to maintain the lifestyle that he wants, coverages of whatever expenses that are there in the near future, and all that is taken care of, right? But if you see till the age of 70, right, the recommendation is to get a cover of at least 3.6 crores. How come, right? At the age of if you see at the age of around 47, right, that is the peak when the expenses are going to be maximum, right? Beyond which, right, the coverage will slowly start to come down because he's going to start reaching an age from where he's coming close to his tenure's end, which means that, he's taken a plan till 70. After 47, right, his expenses will slowly start to essentially decrease, right? Which is why you see that the number also or the coverage itself, the net present value of that money will start decreasing, right? I know this sounds a little complicated, right? But we felt that, this is the best way to give an answer to somebody as to what is the right amount of cover that is required, right? Calculate your expenses, take into consideration inflation, right? Which most of the agents today in the market will never give you an answer, right? They always hide inflation, which makes sure that, Rajiv, if you can just, reduce the inflation to 0 once, right? This is the exact mistake that people end up doing, is not taking inflation into consideration. The second thing most of the agents in the market end up doing is giving you an answer to the question that what happens if I get the money today, right? And if I invest it, right, what is the amount that I'm going to get back, right? They also hide away the rate of return. Rajiv, can you just, reduce the rate of return again to zero there? This inflates your need of money, right? Anukul, who was requiring 3.6 crores today, would be sold a plan worth of 9.2 crores, which he or she does not even need, right? Thereby ensuring that, he or she essentially ends up paying a large sum, which he or she does not even require, right? So, this is the point that we were trying to make, right? How do you calculate? The calculation is going to be this way. Calculate your expenses, make sure that there is inflation and rate of return, make sure that you understand by when will your dependents or financial liabilities be done, right? Do not go for an age beyond which you think that it'll just be greedy enough for me to have this coverage, right? Because you can always make money better ways, right? Anukul, I hope that was helpful, what we've just said.
Indeed, it was. Thanks.
Thank you. So I'll just share my screen. Just a second. Now coming to, what are the metrics to look for while choosing an insurer, right?
Rajiv, can I ask you a question?
Yes, Vinan, please tell me.
Yeah. Is this only for the employees, or can we also insure one of our family members?
You can insure anybody. I think anybody who requires a term will be more than happy to help them out, Vinan.
Okay. Even if the person is a senior in the family?
We can obviously have a discussion, Vinant, but the point is, in case somebody is senior, right, the need for a term insurance, right, decreases as the age goes up because they're more closer to, completing or getting their financial liability sorted. And the premiums that you will end up paying are considerably really, really large.
Okay.
I mean, we can have a discussion about this, maybe over a call. We can have a further discussion on the same, right?
Sure, you can.
I hope that is fine.
Yeah, sure. You can go ahead.
Great, Vinant. Great. Awesome. So coming back to, what are the metrics to look for while choosing an insurer, right? So Rajiv, you've dealt with more than 1,000 plus, conversations, right? How do you think that a person should start elaborating or start thinking about which insurer to go for?
I mean, first and foremost, the person, would obviously look at the claim settlement ratios, right? So with each insurer, they have a claim settlement ratio, which gives us the number of claims they're settling per 100 claims that come in, right? So let's say if an insurer A has a claim settlement ratio of 98%, that means that, out of 100 claims coming in, they're settling 98 of those claims, right? So, which is a good indicator of that company's performance. But that shouldn't be the sole metric for you to judge a company's performance, because claim settlement ratios can be manipulated, right? Where the insurer is settling claims, but paying out half the amount, or not the complete amount, of paying out partially, right? And then boosting their claim settlement ratio. So what we also look at is the amount of annual business that these companies are doing, right? Which is also a good indicator as to this company's performance and their chances of surviving in the long run, right? And the third is the solvency ratio.
Okay.
Right, which gives us a fair idea of how solvent the company is in case claims come in, how much liquidity this company has to pay off these claims, basically. Right?
Got it. That's great. Also, what according to you today is the trend when it comes to term insurance, right? Are the products different for each insurer, right? How does one go about choosing, let's say you've told these metrics, right?
Right.
What else should one look for, in case of choosing the insurer? Is there anything else that you suggest? Like, for example, most of the audience today will end up going to Policy Bazaar and checking out the prices, right? And Policy Bazaar has a plethora of, things that they show for, right?
Correct.
What is the one thing that you feel that a metric should be avoided, that should be looked at by people while searching for a term insurance?
So, in essence, a term product is more or less the same, right? In the basic term product is same across all companies. It's the servicing and the how they handle their customers and the claims is varies vastly from company to company. Now,
Right.
With smaller insurers, the best advantage they can give you is pricing. They have very low prices because they want to sell out more policies. And
Okay.
that's one metric you shouldn't always optimize for, right? Because you'll end up buying a policy from a very small insurer and paying
Right.
very little premiums, but not end up not getting the claim at the end of the day, right? When you actually need it, when your family actually needs it. So
Got it.
yeah, it shouldn't just be the optimizing for price, but an amalgamation of all these other metrics as well, right?
Got it. Great. So I think Rajiv, just to summarize what metrics should look for. One is firstly the claim settlement ratio.
Yep.
Secondly, the amount of business that the company has done. Right. Third thing is the solvency ratio, taking care of because most of the folks will obviously ask a question. Hey Ishtmeet, hey Rajiv, what happens if my company today stops existing for a certain reason, right? Which is the most likely possibility when it comes to these small insurers, right, who offer prices at a throwaway rate, right?
Yes.
Which might not yield you a great product, which will always bring you tension rather, or your dependents, right, will essentially have troubles going ahead, in case you take a insurance from a let's say rather small insurer, right? Now going to the next part, right? Should I buy add-on riders, right? So folks, there are essentially certain what essentially do riders mean, right? Riders means that these are add-on small products that you can attach to your insurance. These are, let's say, complements, or let's say in simple terms, think of them as salt, pepper, right, that are essentially kept on the table that you can always add to your food, right, to make your food taste better and to the likes of what you want, right? Now let's talk about what type of riders are there, right? So Rajiv, if you want to highlight which is the best rider that you think every person today should need or should essentially get for.
So the one rider that actually stands out and actually makes a lot of sense to me personally is the waiver of premium rider, right?
Got it.
The low cost, high utility rider, because what it does is the way it functions is basically in case you're ever diagnosed with a critical illness, this rider will waive off all your future premiums, right? So basically, in case you're diagnosed with, let's say, cancer or are disabled or something like that, all your future premiums will be waived off, and it comes at a very low cost. So this is why I recommend this rider highly.
Okay.
The other rider which I recommend is a critical illness rider, which gives you a lump sum payout in case you're diagnosed with critical illness from one of the one of the illnesses that each insurer covers. Each insurer has a different list of illnesses that they cover, and what this sum can be used for is basically to make up for the loss of income when you would face during such a time, right? When you're diagnosed with a critical illness, you would obviously prefer to take a sabbatical from work, right? Obviously, a health insurance would cover your cost of medical treatments, etc. But this lump sum amount could help you deal with the expenses during such a time and replace your income, basically. So these are two high utility riders that I usually recommend. There are many more riders, but I mean, riders are very specific to each person, right? So one person, it depends upon what you're optimizing for, honestly, right?
Got it.
But yeah, add-ons and riders are a good addition to term plans, but not all riders are the same, right? Not all riders are made equal. So
understood.
Yep.
Got it. Are there any riders that you think are just a gimmick that are set by the insurer, or let's say just these are pure marketing? So somebody mentioned that, I think there's one question in the chat, right, which said that just a second. So Mohit had a question that I've heard that some policies which apart from risk cover do provide some maturity amount also when the policy matures in term insurance, right? So basically, what is your take on return of premium as a rider?
Right. So I don't recommend this rider. I highly don't recommend this rider because think of it, right? I mean, we started off talking about inflation, right? So when you are paying these premiums, you are, not taking inflation into account at the end of the day, right? So 30, 40 years down the line, when you get your premiums back, inflation would have eaten up that amount by that time, and that amount, taking net present value of that money at that point in time, 30, when you're 60, when you're 65, would be nothing. So those premiums you paid would be a very small amount for, instead, if you paid that difference to an index fund, right?
Right.
Difference in premium from the return of premium versus a normal basic term plan, you would have gotten a much higher return in a much larger corpus by investing that in an index fund, honestly. So,
got it. Great suggestion. So just summarizing, what when it comes to add-on riders, waiver of premium is something that one should definitely look for. Critical illness rider is another point. They cost very meager when it comes to your term insurance, right? One should totally avoid a return of premium for a simple reason that they essentially eat up the inflationary amount that you've just mentioned, right? And rather than anything of such sorts, investing in an index fund would give you better returns of the additional amount that costs for the riders about. Yeah. All right. How do I know the right plan for me, right? I think this is a accumulation of what we've just spoken till now, right? The right plan for every individual is absolutely different, right? The way that you can, probably, if you feel that, if you already have a plan, right, you can definitely reach out to us. We can have a consultation where, we can guide you through if your policy is sufficient, what are the deficiencies in your policies, right? What are the next corrective actions that you can take? Or let's say if you're starting from day zero, right, that you feel that, okay, this is the right time for me to get a term insurance, we'll be more than happy to guide you on the same, right? Coming to the next question, right, in the paucity of time, right? We saw that 75% of you essentially have, basically plans from LIC, right? There are, different types of plans which are called as, unit linked insurance plans, money back plans, or guaranteed plans. Basically, these plans are those essentially which have, which tell you that there is an investment and there is an insurance cover, right? While the insurance cover tends to be absolutely meager and does not cover the kind of financial, liabilities that you need, right? It essentially eats away into your investments also that you can make by other means, right? In simple terms, investments and insurance are two separate things, and we definitely suggest you not to mix them up, right? Your insurances are a cover against your financial liabilities, right? They provide your dependents essentially a coverage for, in case of your absence, right? Investments are for more or less for the reasons for you to have a financial corpus for you, for your eternity, for essentially till whenever you are, right? They help you essentially, make or have an additional source of income, right? Also, if you compare in the recent past, right, the average returns of ULIPs, right, essentially have been more or less similar to large cap funds, right? But the cost of these plans, right, are far greater than what it will cost you to invest in a large cap fund, right? There are multiple links that are there on the web that you can essentially go for, right? But our job is to essentially tell you today that never take it for granted that these plans, which essentially have a very small component of insurance, give you an overview saying that I am also making money for you and I'm also giving insurance, right? Please keep your investments and your insurances separate because they absolutely serve two different purposes, right? Now coming to the most important question, right? So many of you attended this session, right? I'm pretty sure when you ask what is the Nova advantage, right? Firstly, we help you navigate whatever was just discussed, right? There are too many points out there in the market which people probably miss out on. And we at Nova, through our innovative consultative process, will help you have the best answer for yourself, right? The second thing is it's not just getting you on the right path, but also ensuring that whatever you have today, in case if it is sufficient or not, we will be able to help you out there itself, right? The third thing that we try to promise you is the fact that, right, today the biggest concern that people have is how do my dependents know whether I have this, what is the use of this policy, right? All your policies can be tracked in one place, which is the Nova portal, right? irrespective whether you are from Nova's, if in case your organization has a policy from Nova or not, we ensure that your policies are mapped to a portal where your dependents are also informed once you've taken a policy, right? The third thing that we also, the another advantage that we see that, there are wide host of benefits that you can utilize on the Nova portal, right? Apart from you having your policies in one place, right? These are the multiple benefits that you can see on our platform, and you can utilize, or your dependents can utilize them on a day-to-day basis, right? I think we've already shot the gun, right? I'm firstly very sorry, right? There are a few questions that we can answer, right? Brijesh, I think your question has been answered, right? Till what age should we get the cover? Mohit, I think your question was answered there. Nikhil, your question is, in case of an uncertain death, within how many days do we report it within the insurance company? So Rajiv, can you take this up once?
This for term insurance, there's no particular limit as such, right? But obviously, since the family would require, I mean, it's in your best interest to sort of declare it to the insurer as soon as that event occurs, right? For you to get the payout early, basically.
Yeah, got it. Great. Brijesh also has another question. Does the number change if someone's spouse is also working and manages half the expenses? So shall both the partners must take 50% cover?
Yes, 100%. So if both partners are working, you'll take your contribution of expenses towards the household expenses as that your month, annual expense sum, and then calculate cover for each individual, basically.
Got it. Muskan and Jay have a very simple question, right? The point they're trying to make is they have a certain bit of cover. They want to increase the cover in their existing policy, or basically get a new policy with a higher cover.
Right. So in this scenario, obviously, different insurers, if you already have a cover, first find out that, does your term plan offer a top up, right? Does it have an option to increase the sum insured? So basically, there's no difference in a sense, because it'll be as good as, fresh underwriting, as good as buying a new policy of, let's say if you're increasing your sum insured by 1 crore, you'd be paying that additional amount on the underwriting basis today, right? So, you could go for either option, but firstly check with your insurer. It's better to have one insurance than multiple insurances. So you can work that out for yourself, basically.
Got it. So the answer there, Jay and Muskan, is the fact that getting a new cover is equivalent to getting a top up in your existing cover is equivalent to getting a new term insurance, right? So it is better to buy a new term altogether with a higher coverage, right? That essentially gives you a far better or a far greater coverage out there, right? I think Mohit has another question. Ishtmeet, if someone smokes or drinks occasionally, does he or she declare or what is buying, basically about the lifestyle, right? So Mohit, the answer here is the fact that when you're smoking or drinking, it depends on how much you smoke and drink, right? The kind of the definition of a smoker or a drinker, according to a term insurance or an insurance company, is the fact that in case you smoke, let's say one company says that in case you smoke more than 10 cigarettes a day, you're considered as a smoker, right? Or if you're drinking more than 90 ml, essentially, per day, you're considered as a drinker, right? So the kind of, definitions for each of them are different. However, what we essentially do is understand of how much of these, lifestyle, this lifestyle, considerations that you have, right? Whatever so it may be, we can have an evaluation of the same and guide you on the way ahead. Now, does it stop essentially, you from getting an insurance? The answer is no. While it increases your premium by some amount, it does not, it ensures that you have some coverage until unless the insurer decides that this is beyond, acceptable, because the kind of smoking or drinking is happening, we'll see a far easier, untimely demise, right? So I hope that answer your questions, Mohit, right? After that, I think Swapnil has asked, can we pay the entire premium within 2 to 3 years instead of 10 to 15 years? Rajiv, how do you want to answer this? It's an interesting question.
Right. So, I mean, this again depends upon what your priority is, right? So, for instance, let's say someone who's, someone who decides, who's planning on retiring early, right? Retiring at an early age, at 30 or 35. These days, we see a lot of people doing that, right? So, I mean, you wouldn't have a active source of income for, for 20, 30 years, right? So it would be in your self-interest to pay off that, your premiums early on in 5 or 10 years or, 2, 3 years, basically. But as opposed to somebody else who's just looking to save money, when you take net present value of that money into account, you're not actually saving a lot of money. It's just, 10 to 15%, right? So it really depends upon what you want to do, right? Is it what your priority is? If you are looking to retire early, I definitely recommend paying off the premiums early. If you're not, and you plan on, it's better to sort of go till the end of the policy term. That's what I usually recommend. That's as a rule of thumb, that you pay for the entire policy term. But yeah, it changes basis your what you're optimizing for, right?
Got it. I think that brings us to the end of the Q&A, right? So folks, in case you have any further questions, right, I'm just dropping a link on the chat box, right? You can schedule a call if, you can. Okay, Ayush has another question. If my term insurance is rejected, does that reduce my chance of getting a new insurance?
I mean, yes, to a great extent. You need to declare if you ever are rejected by an insurer, so that they take that into account. But different insurers have different, metrics of judging, an underwriting a policy. So yeah.
Got it. All right. I hope, Mohit, that answers your question. I think we've shot the time now. I hope, folks, you had a great session, right? I hope there was something that we could essentially help you guys out with, right? Aisha, over to you.
Yes, thank you so much, Ishtmeet and Rajiv. It was a great, insightful session. I am sure, like, a lot of questions, and like I didn't have any basic idea of term insurance, so this helped me a lot for a long extent. And I'm sure there are people who had questions even after having a term insurance with them. So thank you, folks. And we do have another session on the 26th, which is Tuesday. In case you have your friends or anyone who wants to join, please ask them, and they can also register. You can tell them how good today's session was. Also, for registering for upcoming session, I've dropped the link. That's where you can register for the next session. And also, we have a comedy session on Friday, where we'll be having a very chill time and enjoying our weekend. And thank you again. Thank you everyone for joining. You guys can book a call or schedule a consultation with them. I'm also dropping the link here in case you want to set up a call with Ishtmeet or Rajiv. And thank you so much, everyone.
Thanks all.
Thank you, guys.
Great weekend ahead. Yeah.